All right, Yield Nerds, episode 174. Everybody is saying there is a yield tsunami ahead. How am I positioning and what is my stock and bond strategy? I will tell you now. 480 something subscribers. We're coming up on almost 3 years, and I've learned a lot, and I hope I've shared one or two things that have taught you a thing or two. It's been my joy. There are a couple of playlists, and this one will be in the Muni bond and in the income investing roadmap, which is the mother of all playlists for this show. Well, four parts today. One is the market temperature. I'll tell you how I'm doing compared to the NASDAQ, which is just unfathomably amazing. And we'll play Yield Super Bowl, and there is something very interesting going on there, and hence the Yield Tsunami discussion. And I'll explain my rationale for why I'm kind of buying into this Yield Tsunami a little bit, and I'll share what my holdings are. Well, my equity portfolio on an annual basis is giving 29%. But hey, I'm picking and choosing because as you can see, for the last 3 months, my equity portfolio has grown, but definitely it did not fall 20% and catch up. So I certainly cannot keep up with the NASDAQ. Compared to the NASDAQ in the last 3 months, I'm lagging. But hey, I'm doing my best. Well, where am I with respect to my equity allocation? I've finally crossed the 4% mark. I am adding equities, but not jumping into it. And the big news for me is my Muni bonds were at zero, and they are now north of 12%. And I keep adding because I like what I'm seeing there. And my treasuries are the ones that are decreasing, and for all the reasons that I will share with you later in this episode. So let's play Yield Super Bowl as money flies out of my truck. I'd love to show up like that in front of the New York Stock Exchange and start thinking about what to do. Before I share my thinking, I want to make sure you know that I'm not a wealth management advisor. What you're about to hear is not investment advice. You need to do your own homework. Well, what is Yield Super Bowl? We compare pre-tax yields. So anybody that tells you the bank CD matches the treasury is not saying the right answer because treasuries are state tax free. Similarly, I also use the effective tax rate. Our friends at the municipal bond ETFs are really famous for applying the absolute highest marginal tax rate, 39.6%, and saying, hey, a bond that pays 5% is really 8% because every dollar in that bond applies in that 40%, it will be 7% rather, and then they would start arguing that. I don't believe that because once I put that municipal bond coupon into my bank account, it walks, talks, and quacks like every other dollar. So I use effective tax rate when discounting things. So if you have any more questions, you should watch more Yield Super Bowl episodes all the way from the beginning where I explain how I construct it. Well, when we played Yield Super Bowl in 2022, 23, and 25, in 2022, we talked about the classic inverted yield curve and said, oh my God, a recession is around the corner. In 2023, we said, I don't know what the hell this is. This is a yield bump. And then in 2025, we started seeing something really weird, which is the yield bowl. And I kept calling it uncharted territory. And 3 months ago, when we played Yield Super Bowl, Munis dominated the centerfold, and on a pre-tax basis, they were touching 5% across the curve, and treasuries were still paying 4.75%. And another thing we noted 3 months ago was that the middle part of the curve was absolutely bottoming. And we said, oh my God, what's happening? And the irony is the bear end of the curve was still steepening. And we were like, oh, bear steepening is happening. And this was 3 months ago. Guess how it looks today? Get ready and strap on your seatbelt. Woohoo! Look at that. The middle part has absolutely collapsed. That is August. And what that generally tells you is that the market is expecting a rate cut no matter what. For the 10-year to yield less than the 2-year is insane, and for the spread to be that broad, that deep, just means the market is forcing the Fed chair's hands to do to do a rate cut. And so whether you like it or not, whether you think it is right or not, whether Chairman Powell thinks it's right or not, the market is standing upside down begging for a cut. So if you cannot make any yield in the 2 to 9 year time frame, and the only time you can make a reasonable yield is 10 or 20, that decimation generally precedes a recession. Now, how do we know that? Uh, you know, Generally, when the middle of the curve collapses, it means interest rates will decrease soon. That's what has happened in the last 100 years of history, and I'm going to show you more data. But what it does not say is, hey, the dollar may decline here, interest rates may drop, recession may happen, but a bull market has never followed a fall in the middle of the curve. When the 10-2 goes from an inverted to an uninverted, and that is called a disinversion of the curve, meaning the 10 used to be higher than the 2, and now the 2 is gradually higher than the 10. When that disinversion occurs and the middle of the curve falls, generally within 6 months, a recession has happened, rate cuts have followed, the dollar has declined. We have not had a bull market ever. Now, what happens if we play the yield Super Bowl now? Very intriguing again. Treasuries dominate early. Agency bonds offer the nicest yields in the middle of the curve where the treasuries have collapsed, and munis go to the very end. And so the challenge with agency bonds is you may think you locked a nice yield, but they will get called the moment the federal funds rate drops. And so if you want something that cannot quickly be called, you're going to have to go to munis. And that is what I am doing, because at some point, treasuries are going to do this. And the market is telling the treasury to do that. When that happens, usually that's a lagging effect. Usually the stock market will collapse. And I'm hoping, and when that happens, I would have a lot of short-term treasuries that mature and I can jump to the stock market at that time. However, this time is different. At least that's what the pundits say, because the decimation of the curve after the recession and the lower rates, and what they are saying is not only will the stock market collapse, but you will see a huge increase in long-term yields. If that long-term yield increase happens, I want to be positioned to move a bunch of my short-term treasuries to the long end of the curve and also allocate to equities. At least that is what I am waiting for to see where I can go. There are several articles that support this, and there are several articles that oppose it, and they say we are in a never-ending bull market. You do you. This inversion doesn't happen a lot, and this article, I'll put all the links in the description, talks about it. Here is another disinversion. So when the 10 minus 2, that's the simple way of looking at it, when the 10 minus 2 goes from positive, negative, or negative to positive, every single time there has been a recession in short order, and we're looking at the barrel of that. Here is a 40-year curve of the 10 minus 2. Every time the blue shaded portion here, every time it goes from positive, negative, or negative to positive, along comes a recession. And that is why the disinversion, when plotted along with the S&P curve, shows that there is a massive crash right after the disinversion. And so I'm sitting here waiting for that massive crash. Maybe it'll happen, maybe it won't. We'll see where it goes. So that is my rationale for a yield tsunami. So what I am thinking is, if I were to buy into that, obviously I wouldn't own any treasuries in this area. And I, in theory, wouldn't own callable agencies in this area because I think they'd be called. So what am I going to do? My sense tells me any callable bonds in this area will get called when the front end collapses, meaning when the Fed drops its rates. Nobody who owns callable bonds that pay 4 and 5% is going to say, I could refinance this at 2%, but yeah, I'm just going to keep paying 4%. That doesn't happen. There are certain restrictions in the municipal bond side that say you cannot call a bond just for the purpose of reissuing it. However, if the call date has approached, you can indeed call that bond and reissue it at a lower rate. What does that mean? There is a wonderful article called How to Value Callable Municipal Bonds. And that article goes on to say, if you buy a municipal bond at the twilight zone of the 10-year period of a 20-year bond, Meaning somebody, a town, municipality issues a 20-year bond. It is callable after 10 years. As you approach the 10-year period, if it is a callable bond and prevailing interest rates are significantly lower than when the bond was issued, those bonds will get called. And if you were to buy those bonds below par, you can clean up. And I said, gee, I wonder if there are municipal bonds that are a long-term bond approaching the callable window, but pay a healthy coupon that is still higher than the treasury. This is almost like trading a treasury for a municipal bond, which is federally tax deductible, making a higher yield than the treasury, and also saying prayers that it'll get called. Let me explain. Duration of 10 years, investment grade, not on a credit watch negative, exempt from AMT, and please call me callable, and it trades below par. If we can do that, if you can get something where there is 10 more years left on that, and it is callable, in theory, you can make a yield higher than the treasury, and if it gets called, you can make a bounty. Here is what I stand to gain. Conflict of interest, I bought every one of these bonds. So here is a bond from a county that I can see outside my window, Will County. So Will County has a bond that pays 4% for the next 10 years. Remember, that's federal tax deductible or federal tax exempt. So at your tax rate, 4 times 1 plus whatever your effective tax rate is, that is how you should look at it. And it works for me. And for the next 10 years, you can own that, except January 1st of next year, that bond can be called. I can buy it for 99.63, make 4% tax deductible, and if they call that bond on January 1st, I'll make 6.5% on a yield to call basis. Thank you, Will County. If you go down this table, you can see some astounding, crazy things. All of these are AA plus rated bonds, trading at 95 cents on the dollar, pays 4%. February next year is the call date. If the federal funds rate is below where we are now, and you are on the board of the municipality, you're going to sit there and say, hey, Bobby, why are we paying a 4% coupon when I can reissue it at a 3% coupon, have no other penalties? We should be doing that. And if they call that bond, I will make a cool 4% between now and February that is tax exempt, and another 5-6% when I get $100 for $95. My yield to maturity will be 12.83%. Give it to me, please. I hope Ashland, Kentucky Medical Center calls that bond. So this is the logic. I bought a bundle of municipal bonds that meet that criteria. And here is another article that addresses exactly that point. Is there a way to buy a muni bond that is callable? And I liked where that was going. There is a Bloomberg article that talks about disinversion and the upcoming recession. So based on all of that, I've traded a whole bunch more municipal bonds. I own them in that twilight zone, as I told you. As for equities, my little filter continues to outperform. I'm very excited about it. I have returns north of 100 something percent. And as I told you, I only buy on days that my previous trade is in the money. If my previous day trade is not in the money, I just sit and wait for the price to appreciate above my previous trade. And that has done very well for me. I have pages and pages of positive returns. I do have some duds that I've been cleaning up. And this was before I switched my algorithm. But thank you for watching Yield Nerd, and let me know what you are doing and whether you believe in the twilight zone of municipal bonds. Thank you, and have a nice day.